So as the MC I've already mentioned just now, feel free to post all your burning question in the Slido apps, right? So yeah, luckily I don't need to answer all these burning questions. So just bump all the questions that you want to ask all these market experts, and I'll help you to challenge them lah. Huh? So just a very quick warming up. I want to ask all these three experts here. Just now during your presentation, you guys seem to have a little bit of mixed market outlook. So just now, actually during my presentation, I also asked them, 2022, was it a good year? Although some of them say yes lah, but what's your market review in 2022, and what do you think will happen in 2023? Let's start with Mr. Marvin.
Okay, hopefully this mic is still working. Okay, to sum up, 2022 for equities was quite challenging. I think depending on which market you're investing in, it was pretty tough. I think, we talked about the Nasdaq going up over 30% this year. Their fall last year was more than 30%. So, depending where you were invested, it was a tough time for equities. How we expect this year to go, I mean, we are hopeful for a little bit of a clawback. I think first half in certain markets like Malaysia was tough, but the opposite for certain other markets like the Nasdaq. We do hope that the Malaysian market kind of trims its losses, especially towards the second half. I think, a lot of the factors we've talked about, being under-owned or positioning for next year, we do hope that will help.
Wow, okay, so next, Miss Esther, what's your view about that?
So just now I did share about how 2022 was for the bond market. It was a very tough year. And it's a tough year from all aspects where we have high interest rates. And I think something I did not touch about in my presentation was the number of defaults in the China property sector that caused major sell-off in the Asian bond market. That was another challenging period for Asian fixed income. And I think this year we should expect a recovery in terms of bond performance. But how strong that recovery would depends on, still very much data dependent and what central banks would do. Although, like I mentioned, we think we are a lot closer to the end of the rate hike cycle compared to 2022. So, we expect bond performance this year, to range, depending on which market you're looking at. But we are bullish on certain markets like US, Malaysia, some of the Asian countries. We think it could give you maybe 4 to 6% return this year compared to the negative return last year.
Interesting. So, Mr. Wu, your view?
I think they said everything already lah. Okay, my 2 cents worth is that, as I mentioned, even though how bad it was last year, there's still a couple of regions that actually you make money. In India and ASEAN, right? And actually, if you have something in the Malaysian bond fund, actually the Malaysian bond fund will actually mildly positive towards the end of the year, and the whole year over 1% up as well. So there are always parts and pieces that whereby you have to be aware of, and I think FSM want to have the platform that can help you with that. So for me, last year was a very tough year. I think out of 260 working days, 52 times 5, 260 working days, I think more than 200 days the market is only one direction, down. Right? The rest is flat or not going anywhere. But this year is much better. It's almost even, or actually, depending on where you are. And even in Malaysia, the big index did not perform. But if you have those who are a little bit more adventurous and taken a position in the small mid-cap space, you will actually be having positive gains. All right, that's a reality. And also, there's also a reflection of the structure of the Malaysian economy. Because how much more do you think that Maybank and Sime Darby can grow, all right? While the growth will most probably come from the SMEs around the zone. And most of our SMEs services multinationals. They are audited by multinationals. So they do are of a certain class, right? So this is something like that. So generally what it means is, I repeat, and it sounds cliche, is be aware, be very nimble, know what you are, be risk aware, and try to avoid all the noises. You'll read all sorts of funny headlines. And you go on YouTube, it's even worse. They will tell you everything is collapsing. All right. So you need to be your own, you need to sieve everything properly. That's all I can say. Thank you very much.
All right, thank you, Mr. Wu. Well, it's just a very interesting outlook and also market review about 2022 and 2023. So, yeah, let's move a little bit from the US side. Definitely coming to 2023, a lot of people, main topic, recession, because of the PMI contraction, because of yield curve inversion. So, I'm going to throw this question to Mr. Wu again. Do you think that the recession, we're going to be very severe kind of recession, or it will be a mild recession, or even if no recession? What's your case for recession?
Biggest worry is your inflation do not go down. Then to break the inflation, even though it's flat, let's say at 4% now, right? It's still too high for comfort. So to break it, you need to raise interest rates beyond 6%. Effectively, you force yourself to go into a recession. That's the reality. That will be the worst case scenario. All right. And as I explained earlier, part of the US economy actually have a very shared workforce, especially the technology sector, right? But then the rest seems to be pretty resilient. But I think it's make up from the fact that most of them are contract workers, which is of different costs, right? So people are still maintaining that. I think partly maybe because of the effects of a lot of savings, money not spent from last year. After the supply chain disruption, you do not have enough manpower to face your customers. So you have various type of factors in play that you've seen such so-called resilient employment data, I would put it that way, all right? But other than that, go back, become a little bit academic, because in previous examples before the 2008 crisis, right? US real interest rates, that means real interest rates minus inflation, is always in the region of 50 to 65 basis points, the positive part. And after 2008, it was negative for a long, long time because they need it to rescue the US economy. But I guess those is over and people now are going back. At current level, if you look at the inflation trend, even whether it's core or headline, if it continues to behave as it is now, it will eventually reach something like anything from to 3.5 for headline, 4.5 for core, which compared to current level of 5.25, you're talking about over 100 basis point of real interest rates. Academically, they call it really, really tight monetary policy, all right? And whether that is something the Federal Reserve really want to pursue, I have no idea. Because as long as the GDP number going forward start to look weak, your downtrend to inflation continues, I think this is where they will have to make in their mind how their dialogue and how they communicate their policy making views more, either they are less harsh as of now, because if not, they will definitely drive the economy into a real recession. At this juncture, a lot of forecasts is, first quarter, they really miss it by a lot. Market was talking about 1.9. They came out about 1.1 or 1.3. So that's a huge miss. Second quarter, people talking about maybe near to zero. Third quarter, maybe a mild negative. So the question is whether fourth quarter is going to be another negative, all right? That's where I think will be the crunch time. And for me, this quarter is when the effect of the high interest rates adjustment would start to really be felt, and whether the GDP number will be bad. All right. Of course, unfortunately, the worse it is would means that the faster they need to cut interest rates to rescue the situation. But you must remember, currently the slowdown in European and US economy is a function of higher cost of business. It's not like in 2008, the property sector collapsed, then the banking sector collapsed. Then the whole global financial system just froze up, right? Then nothing works. That's a real crisis. Here is, if nothing really breaks, then you're talking about, it's just a normal cyclical slowdown. And that's why you see the World Bank forecasts have been talking about a recovery in next year. And you can only achieve such an easy turnaround provided there's no major issue that you face, right? So this is something that I will answer your question. Sorry, it's kocak lah.
Okay, thanks, Mr. Wu, for the in-depth explanation, right? So, Mr. Wu, just now we do mention about technology, and definitely it's one of our hottest questions because we have just experienced a very, very technology-led rally. Mr. Marvin, you do mention about Malaysia tech space. Would you like to comment some of your view about the US tech? Do you think that it's a bubble, or maybe in a layman term, do you think that this kind of rally is sustainable?
Okay, I mean, as I've talked about, I think the US tech rally has been very narrow. It's been focused on one theme. I think, you can't avoid reading it in the papers. It's basically AI. Now, the AI market, it's still supremely early in its stage. I think, in terms of how to monetize it, all that, there's probably no concrete plans or, no good guidelines you have right now. So on that basis, even 1 month ago, you can always say, oh, this market is overvalued. On a fundamental basis, you can't tell, where the earnings of these things are coming from. The only thing is people are expecting the potential to be huge. I think just simple examples from ChatGPT has, scared people off, at how good it is at creating certain kinds of content. So, this sort of rally on a fundamental basis is very hard to call in terms of whether it's over, or how far it's overvalued and, how much further legs it can go. I think maybe the perspective to take in terms of saying, how much legs it has is, what can spoil the story. So we've started to see, news, for example, they said all this machine learning AI has been relying on public data. Some of these firms, they scrape data from everything available online. So, this is maybe more a US story, but, who owns this data in terms of personal data rights, Are people allowed to scrape this data for free? And, we've indeed seen, some lawsuits start to come up because they think, ChatGPT is probably very well capitalized, very large investors in them. Lawsuits have started to come up, we want to sue them because you took our data and you're not paying us. And this data is what makes your AI so good. So I think, when you hear more of these kind of stories start to pierce the bubble of that story, that's when you will see a larger slowdown in terms of this tech rally.
Right, thanks, Mr. Marvin. Speaking of tech, actually it made me think of a few days ago, we all know, right, China, they imposed some of the export ban of some of the raw materials to US. Even earlier this year, US already did some of this kind of stuff to China. So with this kind of geopolitical tension, do you think that deglobalization is a trend moving onwards? Maybe you can start with Miss Esther.
I think over the last few decades, we have seen globalization, right? And the theme about deglobalization is kind of getting traction because of what you mentioned, all this tit for tat, trade war, when two superpower, I think, try to grab the top spot, you tend to see all these kind of conflicts. But I would say that the world is unlikely to be deglobalized. We are very much interlinked in terms of trades, financial systems, even every part of our world. But what we are seeing is, I think companies and governments try to diversify their risk. So, for example, if you are a US company that has relied on having a manufacturing plant in China all these years for the cheap labor and all that, now you'll be thinking about, I think I should have a second plant. I should be looking at diversifying my source. And similarly for Chinese companies, and I don't think it's just US and China, it's Europe as well, it's Australia, the world is kind of split into two camps, right? You have the Western and the China camp. So I think this will continue on, and it will shape investment as well in terms of opportunities, risk. And this is where we are quite bullish about ASEAN, right? Being that we do have the infrastructure, we have the labor, we have, Malaysia, we can speak English. What we need is just more competitive policy, perhaps to attract even more FDI. So I think this theme, we will look at it as both risk and opportunities. Why risk is because it will become more volatile to invest given all these geopolitical tensions. And that will be something that we have to live with for many years to come.
Right, thank you, Ms. Esther. Mr. Wu, do you have anything to add on about this topic?
It's too late to roll back the carpet. We already walked down the carpet quite substantially down the road. Even, I think Africa itself is also inside the global picture nowadays. Although they yet to become the source of cheap labor for manufacturing now. But eventually it will come, I think. But I will put it this way. What it would mean is there will be a period whereby the governments have to sort out what can work for them. And because of what can work for the government, then will be translated to what would the private companies think will work for them because of the government policies. Like Apple is like, India now is my favorite darling already, right? Or something like that. So you have to think of how the rest is thinking. Like Esther also just now mentioned, even the Chinese companies themselves. Because if you are just a normal businessman who export to US and Europe, your product is not any incredible product, but you are sufficiently competitive. Because of the higher tariffs, you find that I find it difficult to grow further. So you will need to shift out of China. Not that you are not loyal to your country, but continuity of your business is more important as a businessman, right? So you just relocate whether to Vietnam or Malaysia, set up a plant and go forth. So this type of, maybe you can call it localized globalization. We think that China, that within ASEAN, I think we have a great spectrum. We have a near developed market, which is Singapore. Then we have a really third world country in the likes of Cambodia and Burma, eventually, if they become more stable. So we have a broad spectrum of 700 million people, whereby you can offer from the most expensive Birkin bag to the basic essential of sugar, which ASEAN itself can absorb. So this is something that you have to put it in consideration and perspective.
All right, thanks, Mr. Wu, for so many insightful sharing, right, about the geopolitical tension, right? So speaking of geopolitical tension, just now we have discussed about the development in US. Let's move to another superpower, China. So basically, my question is pretty simple. I just want to I want to include all three speakers here. Just very simple. Your answer will be buy, hold, or sell for China. Let's start with Mr. Marvin.
Wow, that's a very tough one. I'm tempted to ignore you and just go on a few sentences. But I think you can't avoid buy. Okay, I'll just leave it there for now.
Okay, Miss Esther.
Are you talking about stocks or bonds?
Yeah, you can go for both.
I would answer, because I get asked about China all the time. And I think as Malaysian investors, everyone in the room will sure have China, right? But I would ask you back, how much China do you already have? Because you need to make sure that you're diversified. And I think if you have already a lot of China, you may not want to tambah lagi, right? But if you don't have a lot, I think it's worth to bet that, it is a very big market that you cannot avoid. So I think you need to have some exposure. For bond, I think for bond market, I am bullish on the government bonds, but I'm bearish on the high yield.
I'm going to stop you here. Just now you mentioned about you want to bearish on high yield. Do you have any reason to do so?
Okay, so for Chinese high yield, a lot of the high yield bonds in China is the property bonds, right? The other big sector is the industrial sector, manufacturing, chemicals. So if we think that the China economy is not reopening as fast, the industrial might struggle, right? And also, I think China, in the last decade, they have grown a lot. The private companies, they grew a lot by leverage. Means they borrow a lot of money to grow, right? But if growth slow down, and if the China government continue to kind of tighten, or making sure that these companies don't over leverage, it will be very hard for them to survive, right? So I think for the investment grade, high quality, low leverage, they should be fine. But for the high yield guys, it will be very challenging. And that's why we think that it is, even though the yields look very attractive, you can get 25, 30%, 50%, but the risk of a default is actually very real in China. Yeah.
Right, thanks, Miss Esther. Mr. Wu, your turn.
I think just now I allude to the fact that because the Chinese market have grown to be very, very big, so that you can now actually even diversify between A share and H share, which is equities, and talking about even equity, and within the equity portion, bond part, you also have the high yield and investment grade. So if you think you do not want to further, you already have enough China. The question is, do you need only one type of China exposure? You may have to take the pain and restructure what you have home in China. You can really now, if you just only want equities, then you ask yourself, can I diversify between H and A? But if you say you want to be even more conservative, I say, I want to have a diversification between equity and bond. Then this again is another way that you can talk about where you are. So for me, I agree with Esther strongly. The investment grade GLC linked bonds will be something that I will be very, very happy to look at. Or even their top grade property companies, because those will never fail, right? Kohli, CRN, some of these will be fine, right? The rest, I don't know, all right? Especially those who grew very, very fast on very high gearing. That one definitely, 100-foot pole, I would not go near that. Equity will be more diverse, right? So it's a matter of where you want to be for that, on that basis, right? Because if you look at, if they are talking about policy support, the A share market will be a major beneficiary compared to H share. As simple as that, right? So this is where the diversification can take place for you for equities. All right, be all right? Thanks.
Yep. Thank you, Mr. Wu. Well, Mr. Marvin, actually just now your answer is quite short, so I wouldn't let it go that easily.
Okay.
Would you mind to explain some of the reasons? Despite, throughout the years, actually Chinese government has injected so many stimuli into the economy, but it seems like the market doesn't really react to it. So what's the reason and what's your outlook moving onwards about this?
Sure. I think, Mr. Wu kind of covered, a lot of the bases. I think if the question is specifically why stimulus hasn't helped that much, I think, they have been very careful and they've been very selective. And I think they also want to be they've been trying to be seen as not being too protective of even, some of the very large companies. So, when you saw a lot of the Chinese property companies had, their bonds basically go bust, I think, the signal is, not even the largest companies are not fully backstopped. I think that was the signal. So, but, rounding back to the question, can you avoid China? No. I think, the size is too huge, in terms of exposure, you won't be diversified enough if you avoid it. Is stimulus the only thing to look forward to? Not the case also, they are attached to a lot of growth levers, relating in Asia. So I think, as long as you have the ability to be selective, talking about equities here, within certain segments, I think, you can't avoid China.
Well, thanks for the explanation. For China, definitely geopolitical tension is one of the things that we need to take note a lot, and hopefully the government will continue to be that supportive. And hopefully Yellen is enjoying her China trip, so we have more good news coming in, probably next week, who knows? Well, after China, right, let us move a little bit to our domestic side. Everyone knows the state election is coming, and everyone knows political issue is always one of the headwinds to stop FVNKLCI from growing. So from the equity perspective, Mr. Marvin, just now you already mentioned you give us some insight about your outlook for the equity. So do you think that basically it's just very simple. What's your expectation of this state election and what's your outlook moving ahead?
Wow, okay, that's a very dangerous question to answer. But okay, I would put it like this. The consensus view now is status quo, basically after the elections are all completed. So is there room for disappointment? Again, you have to contrast expectations and all that. So there is some room for disappointment. Now, when you talk about political risk, there's always two aspects that we are concerned about. I mean, it's not just the sentiment. The other thing is, what kind of policies may be either put in place or, be at risk after, some kind of political change. So in the case where status quo is not the outcome, I think, there are certain sectors in the Malaysian market, including larger caps, that are at risk. Basically, again, I don't want to be too specific, but there may be some sectors that have, financial impact as an outcome of potential new policies. So, just a simple risk on from a status quo outcome would be positive for the market. I think that would be quite straightforward. Yeah.
Okay, that's a very prudent answer. Let's throw this question to Mr. Wu. Because I noticed that one of the top questions is our Slido, right? What if, example, the green wave really comes? What is the impact to the economy?
I thought we can survive anywhere in the world. No, let me put it this way. Start from the top, right? I think in terms of hardware, there's hardly any issue with the country. That means in terms of roads, ports, power supply, blah, 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 it's never an issue for us. Actually, we have some of the best infrastructure in town. If there's an issue is somebody wrote the algorithms wrong, we just go around the circle, the roundabout. We can never get out of the roundabout for the last 10 years. But for me, it's also a sign that a number of other countries went through similar type of political uncertainties for a number of years. It's part of growing up. And the people eventually have to learn that sometimes we need to make the right decision, not because what you believe in or what you are. That's something very, very important. And the other thing that is prevalent within Asia and even in Malaysia is that Asians generally are brought up to be good at taking instructions. And, the people running the country, which we elected them, they should be taking our instructions, but they end up giving us instructions. And most of the time, because of how we were brought up, we just follow. I'm not asking you that you should rise up every day like what's happening in France now. No, please, not that. But you think that it's time to change, this is where I think you go to the polling station and you make the change. And you make sure that if this is the change you want and this is the current environment you want, and it should also be expressed similarly in the state election. That's all I can say. And if that is the case, then his version of status quo, or even slightly better than status quo, I hope, then we can have a decent run in the market. Because, like I mentioned earlier, right, the big caps have nowhere to grow. Maybank makes 8 billion ringgit a year. Do you think they can make 10%, 800 million additional every year going forward? That's not possible. You know how much loans growth that they need to grow to achieve that number? That's crazy. So you can achieve 2-3% a year is already superbly great. So they end up what you call dividend-paying company. What you want, if you the growth and excitement is where the small mid-caps is, and reality is, one statistics, across the whole world, SMEs provide 70% of employment, 80% of GDP of the country, right? And you want to look for winners, usually that's what you look at. But unfortunately, by lack of size, it's more vulnerable to economic changes and political changes. So this is the only part whereby one will have to be careful of. Okay? Thank you very much.
All right, thank you for answering such a dangerous question. Well, Miss Esther, no worries, you have a safer option. I just want to ask you, just like you do mention about you kind of like Malaysia fixed income space, right? So what's the reason and what's your expectation about our interest rate?
Okay, I'll tackle the first part, the second question about interest rates. So I do think that Bank Negara is done with their rate hike at 3%. There has been a lot of debate and talk whether Bank Negara had to hike interest rates because the ringgit is so weak, right? I mean, you can say that ringgit is weak because of the strong US dollars. But if you compare the ringgit against our regional peers, we are actually underperforming. So there is a lot of pressure and a lot of news. Every day you read about ringgit. When you want to travel, you also look at the ringgit, right? So I think there is that pressure, but I believe Bank Negara would not do it just because of the ringgit. They can use other measures to manage that. But I think Bank Negara also make it clear that they are letting ringgit to be market driven. They will just manage the volatility to make sure that it's not being too volatile, but then it has to be a market driven exchange rate. Yeah, so why I say that interest rate in Malaysia at 3% we think is quite appropriate at this point is because we are seeing a global economic slowdown. And also, I think in the latest Bank Negara, statement, the government mentioned about they are concerned about the global slowdown. So Bank Negara is more concerned about the growth. And yes, they said inflation is also trending down, but core inflation is still a little bit higher. But I think they can wait for more data to see whether there is really a need for a rate hike. But because our base case is that the US is likely to pause in third quarter, that's why we have a view that Bank Negara is unlikely to hike anymore. So moving on to the Malaysian bond market, given that our interest rate is quite stable at 3%, I think the bond market in Malaysia is also one of the more defensive bond market in the world. So just now, Mr. Wu mentioned that last year, even though in a very challenging market environment for fixed income investors, Malaysian bond actually managed to squeeze out some slight positive return, which really outperformed most of the global bond market, So I think that is a reflection of, we have a very big pool of liquidity in Malaysia. What I mean by that is the pension funds, the insurance companies, the banks, consumers like you and me, we have high saving rates, and a lot of this money goes to the bond market and be able to support the bond market. Yeah, so with the stable interest rates, we think that Malaysian bond is not going to be very exciting, but it will give you that steady return, right? So if you're looking for 4 to 5%, better than our FD rate, this is where you can invest your money.
Right, thanks, Miss Esther. Mr. Marvin, just now Miss Esther has talked about her insights or her thoughts about ringgit and also interest rate. So what's your view on, I ask you 3 questions. What's your view on ringgit, Malaysian interest rate, and also how will it impact our equity market?
Okay, that's a lot to pack into one. Okay, but I'll go in the the more natural order. I think Ms. Esther touched on basically all the key points. I think as far as interest rates are concerned, there's probably not much reason to hike further. Vis-a-vis the ringgit. Now I think I've pointed out earlier a lot of the challenge the ringgit has now is actually due to global flows and the linkage increasingly with the renminbi. So because of that, it's very hard to tie it purely to the interest rate regime here. Even if BNM were to hike, I think they also acknowledge it may not help the ringgit much if they hike another 25, 50 bips from here. So it will be counterproductive. So because of that, I think it's hard to call where the bottom of the ringgit is unless you also call the bottom of the yuan. And that one, is a challenge beyond me. I think that one also involves where you think global trade will go. If a global slowdown is severe enough, I think the impact on the yuan, on the Chinese exports and trade will be even larger. Now, I think tying back to how that might impact the market, I think increasingly we do hear from foreign investors, I think the weak ringgit can be seen as an opportunity. If they do think, structurally there's not too many problems, I think, a weak ringgit means you do get a better entry point, especially if they also think equities can perform longer term. So, as long as, the ringgit does not depreciate too quickly and too sharply in the near term, and, interest rates are kept at, the current levels, which are reasonable, I think that should help the local market.
Right, thanks Mr. Marvin for mentioning about the weak ringgit could be the opportunity to boost the domestic burst. Well, personally, of course, I hope the ringgit to be strengthened a bit so I can go and travel. But too bad, it's a very dilemma kind of question. Well, speaking of dilemma, I believe there are a lot of investors here, especially after they have been through a roller coaster 2022. So I look at the time, we only have 5 minutes left. So I just probably have one last question to all the speakers here. Actually, initially, earlier this morning, I presented how to build your portfolio using the way of nasi lemak. So basically, just a quick introduction. If you want to build a portfolio, you need to build maybe nasi will be my US equity. Maybe I want to put a little bit of sambal like US tech, a little bit of drumstick like China tech. This is just an example. So in the case of forming your own nasi lemak, what kind of advice or what kind of portfolio positioning would you provide some insight to investors here? Maybe we can start from Mr. Wu.
If I just have 4 funds I want to buy, just take it as 4 funds. I will have 2 tactical ones, one in technology, one in China. Then I would want to have something that is protected from China. I have ASEAN and bonds. So these will be the 4 that I will have. And technology and China at any one time will be no more than 40%. But for example, if Hong Kong drop a little bit more, you'll go up to 45%, technically. And if it rebound to 22,000, you're back to what it is. But my bonds and my ASEAN will generally have very little movements. I'll hold on for the stability and the income, in particular for the bonds. All right. If it's the bond side, you can pick it up, right? For me, I will buy a global ETF for US government sovereign. And perhaps if there is available a Asian credit ETF, we should have high yields. And the moment cyclically the interest rates 10-year yield turn, those will provide the best returns. And it must be investment grade. It's not time for high yield yet. Too much volatility. Okay? That's how I will put it out. That's how I will play it. Thanks.
Right, thanks, Mr. Wu. Miss Esther.
Yeah, so I think if you use the terminology of nasi lemak, I think what is important is when you look at tactical funds, and I'm glad that Mr. Wu mentioned tech or like China, those should be your tactical. It shouldn't be your rice because they are very highly volatile and very cyclical. So I think, every individual investor is different, right? Depending on your risk profile, your ability to take risks, how much long-term or short-term horizon that you have. So it's very hard to be up here and tell you what is the asset allocation you should have. But personally, for me, is that after the very big correction that we have seen in bonds, we think that bond really offer a very sweet investment because you're not taking as much risk as equity market, but it can still give you a very decent 5, 6, 7% return. So for me, my bond would be my rice. And then I will have all the equity as my other ingredients that will have that a little bit more excitement, but also give you that potential long-term returns. And then my bond will be giving me that regular income. Yeah.
All right. Mr. Marvin.
Okay, I think the challenge with going last after our 2 esteemed speakers, it sounds like I'm going to be copying them a little bit. But you have to give a where I hope a slightly different perspective. I think structurally, we do expect globally the rates regime should be on a downtrend. So from that perspective, you can't argue with a point. A slight overweight in fixed income or bonds it makes a lot of sense. Now, from equities perspective, valuations are at multi-years lows, and you've heard from me or many others. There's a lot of catalysts coming next year. The better parts are still to come. So from that perspective, I do want more weight in equities as well. But I think some of the challenges we talked about are structural, like when you talked about potential deglobalization or more at least polarization between US and China. So in the equity space, you can't just say overweight. I think being selective is the most key. I think ASEAN still has a lot to offer, while at the same time being very cheap, and the structural story of FDIs and etc. China, I think I've talked about, where slightly more domestic focus makes a lot of sense. And as far as developed markets, especially the US, some of the mega trends are like, just to bring back the AI example, you can't avoid, or maybe the best exposure is still coming from the US. So from that perspective, they do need a fair amount of weight. Yeah.
Well, all right. Thanks all the speakers for giving us such an insightful presentation. And I would like to get... so I think that's all for our panelist session. And thanks again for all the speakers spending your time here.